Welcome back to The Deep Dive, the place where we cut through the noise and get you straight to the essential insights from stacks of information. And hey, before we dive in, just a quick word for all of you watching or listening. You can find us and actually even more in-depth market analysis over on our YouTube channel, Market Insight Cast. So definitely go check us out after this deep dive. Right, so today we're plunging into an event that's got the tech world absolutely buzzing, design pros watching really closely, and day traders basically on high alert. The Figma Inc. initial public offering. We've been handed this fascinating array of sources, everything from the really vibrant, sometimes unfiltered discussions happening in global online communities, think Reddit, Korean forums, right through to these meticulous deep dives into Figma's, pretty intricate financials and the really compelling story behind its history. Our mission, simple. Extract every single important nugget of knowledge, understand the surprising facts that might be lurking just beneath the surface, and ultimately help you navigate what everyone expects to be pretty high volatility around this major market event.
Okay, let's unpack this a bit. Figma. It's a name that's basically synonymous with modern collaborative design, right? And it's finally making its grand debut on the New York Stock Exchange.
The anticipation is, well, you can feel it. It's palpable. Lots of people are expecting a pretty significant surge on listing day. But what's truly driving all this excitement, and maybe more importantly, what are the hidden currents beneath the surface? It's kind of like looking at an iceberg, you know? You see the tip, but the real mass, the real story is submerged. So we're going to dive into what day traders are looking for, what long-term investors should genuinely be considering, and how these strikingly different online communities are reacting. It's quite the contrast.
That's a crucial distinction right off the bat, and you've really highlighted the core tension perfectly there. What's particularly fascinating, I think, is this clear disconnect that seems to be emerging. On one hand, you have the company's long-term vision, which seems built on, sustained innovation and creating fundamental value. And on the other, you have the market's immediate, often intensely speculative interest. So while there's certainly an undeniable buzz around Figma, and for good reason, we really need to consider the historical warnings, the patterns that suggest this won't necessarily be a straightforward ride for everyone involved. The core insight for you listening, I think, is clear. The market is really wrestling with Figma's undeniable fundamental strength versus this historical pattern of IPOs often being used for these short-term speculative plays. And this really raises an important question, doesn't it? Is this IPO a genuine revaluation of a fundamentally strong, highly innovative company? Or are we perhaps witnessing the setup for another classic pump and dump scenario that, while unfortunately often leaves retail investors holding the bag?
That's a really powerful question to frame our whole discussion, actually. And it forces us to look beyond just the hype, doesn't it? To really understand what we're dealing with, I think we first need to get to the core of Figma itself, what it is, its impact, and why it commands such fervent loyalty. For those of you who might not be sort of immersed in the daily rhythm of the design world, Figma is essentially a cloud-based collaborative design platform. It's truly been a transformative tool, reshaping how digital products are conceived and built. Imagine working on a really complex digital design, maybe an app, a website, some software interface with multiple people, all at the same time, in real time. Kind of like you would on a Google Doc, right? That's the power of Figma's real-time co-creation. It lets teams iterate, share feedback, build together in a way that was, frankly, unimaginable before. It just eliminates all those version control headaches and bottlenecks. And one of its standout features, something that's truly streamlined workflows and bridged these critical gaps, is Dev Mode. Now, this innovative tool isn't just a convenience, it's a real game changer.
It allows designers to easily convert their intricate designs directly into code. So it effectively serves as this universal translator between the creative design teams and the technical development teams. Anyone who's worked in tech knows that's not just a feature, that's practically a miracle for workflow efficiency and speed to market. And the numbers, they really paint a vivid picture of its market dominance. Figma boasts over 13 million monthly active users, which is huge. Then you look at enterprise adoption, and it's even more impressive. 95% of Fortune 500 companies and a staggering 78% of Forbes Global 2000 firms, they all leverage Figma products. We're talking about near ubiquitous presence in the corporate design world. It's really established itself as the industry standard. Their revenue model is equally robust. It's subscription-based, which provides this predictable, recurring, and highly scalable income stream. As many users on Reddit passionately put it, Figma is seen as the absolute standard for design execution. They talk about its exclusive position and strong moat in UX, meaning it has this powerful, defensible competitive advantage. Many professionals genuinely consider it essential for their daily work. That speaks volumes about its ingrained utility and, frankly, the high barriers to entry for any potential competitor.
Indeed, the product strength is undeniable. And that market entrenchment is certainly a huge plus. Figma has built an incredibly strong product, carved out a commanding market position. Few rivals can really match it in that collaborative space. However, while we acknowledge its revolutionary past, the question that keeps coming up, especially from a forward-looking perspective, is this: has Figma's core UX innovation already squeezed out all the major gains it can? I mean, if their foundational collaborative and interface design innovations have largely matured, future growth might start to look very different. It might have to rely more heavily on, say, incremental price increases or pushing existing users onto premium plans, maybe expanding into adjacent, perhaps less disruptive product areas, rather than, expanding their user base through truly groundbreaking new features that capture entirely new market segments. And that's not a minor concern, not in a sector that demands continuous, often disruptive innovation just to stay ahead. Another significant point of concern, I think, is the competition. While Figma currently dominates collaborative design, there's always the risk, isn't there, of it becoming perceived as more of a pure graphics tool, and consequently losing some market share to rivals like, say, Canva. Canva focuses on broader accessibility, user-friendly templates, a wider audience beyond just those professional UI/UX designers. Now, while Canva and Figma serve slightly different niches today, that line can blur. And Canva's rapid growth, its ease of use, it could potentially pull away segments of the market that don't need Figma's deeper, maybe more complex functionalities. So this raises an important question that investors really have to grapple with. What about the ability to build beyond Figma's current core? Has their platform reached a point where further transformative innovation might be limited? Or are they truly poised for continued revolutionary advancements that can sustain that impressive growth trajectory? These are crucial considerations, I think, for long-term valuation that go way beyond just admiring the current product, as impressive as it is.
Those are incredibly valid points. Sustaining innovation, fending off competitors, it's the perpetual challenge in tech, isn't it? But let's shift focus now to the nuts and bolts of the IPO itself, because this is what's getting day traders and long-term investors alike really buzzing with anticipation. So Figma is set to list on the venerable New York Stock Exchange. The ticker symbol will be EVISG, and the anticipated listing date is July 31st, 2025. The initial offering price range, this is key, is set at a pretty tight $25 to $28 per share. That aims for a fully diluted valuation, meaning including all potential shares, like from stock options and such, of anywhere from $14.6 billion to $16.4 billion. That's the range, basically, that the underwriters and the company believe reflects Figma's current market worth just before it starts trading publicly. Now, in terms of share distribution, Figma plans to offer approximately 37 million shares to the public. Breaking that down a bit further, 12.5 million of these will be brand new shares issued directly by the company. So that's essentially injecting fresh capital right into Figma's coffers.
But the remaining 24.5 million shares, and this is important, will come from existing stockholders. That primarily means early investors, maybe some company insiders, selling a portion of their holdings. This whole offering is designed to raise up to $1.03 billion in total capital from the market. And as for the big names orchestrating this massive event, you'll see prominent underwriters like Morgan Stanley, Goldman Sachs, Allen & Co., and JP Morgan, basically a roster of financial titans lending their prestige to the offering.
Oh, and a really interesting detail I think that speaks to stable leadership and maybe a long-term vision is that co-founder and CEO Dylan Field will retain significant control even after the IPO. He's set to hold 73.6% of the company's voting rights through his Class B shares. These carry a super voting power, like 15 votes per share, giving him this powerful, stable grip on the company's strategic direction. It kind of insulates it somewhat from short-term market pressures, you'd think.
Right. And while that targeted capital raise of over $1 billion certainly sounds ambitious, maybe impressive, it's absolutely crucial for you, the listener, to note a critical detail. It often gets overlooked in the headlines. The company itself, Figma, obtains no revenue whatsoever from those 24.5 million shares being sold by existing stockholders. That's nearly 2/3 of the shares offered. This isn't new capital flowing into Figma for, product development or expansion or strategic acquisitions. The primary purpose of those shares being sold by early investors and founders is simply to provide them with liquidity. It's a chance to cash out some of their hard-earned gains after years of private investment. This distinction is absolutely critical when you're assessing how much new capital is actually flowing into Figma for its future operations and growth initiatives. It's not nearly as much as that headline billion-dollar number might suggest for the company's direct use. Furthermore, an enterprise valuation hitting $16.4 billion at the top end, well, that's substantial. It really is, especially for a company with Figma's current revenue profile. And despite what looks like strong demand during the pre-IPO roadshow and a carefully considered offering price, The inherent volatility, and we see this time and time again with tech IPOs, suggests that the stock might end up being even more overvalued by the time retail investors like you can actually enter the market on listing day. This happens because that initial surge, often driven by institutional investors and day traders looking for those quick profits, frequently prices out the average individual investor. You just can't get in at the initial offering price. The stock can open significantly higher, sometimes dramatically higher than its IPO price, and that immediately puts retail investors at a disadvantage if they end up chasing those initial spikes. It's a significant challenge for anyone looking to invest right on day one.
Yeah, that's a really common frustration. And speaking of valuation and market perception, we just can't discuss Figma's journey to IPO without recounting that dramatic Adobe saga, right? Which played out about a year before this planned public offering. Figma was right on the cusp of being acquired by Adobe in this, well, monumental $20 billion deal. That figure alone just speaks volumes about how Figma was perceived, its value. But in a pretty dramatic turn, the deal ultimately fell through. The reasons were squarely regulatory. There was significant opposition from UK and European regulatory authorities, plus a concurrent investigation by the US Department of Justice, all citing concerns about market competition, potential monopolies in the creative software space. The silver lining for Figma, at least from a financial standpoint, was that they received a substantial $1 billion termination fee directly from Adobe as a result of the deal collapsing. That windfall provided them with significant capital without having to give up control. But here's where it truly gets fascinating, I think, and it powerfully underscores Figma's perceived value, maybe even beyond that $20 billion initial offer.
There's this intriguing analysis that's been widely discussed in financial circles, that the actual value of that Adobe acquisition, had it gone through, could have approached an astounding $30 billion. Why such a huge leap? Well, because Adobe's own stock price surged significantly right after the initial acquisition announcement. And that would have consequently increased the value of the stock component of the deal, making Figma's founders and early investors even wealthier. So this history isn't just some mere footnote in Figma's past. It's a powerful, almost undeniable market validation for Figma's potential. It clearly demonstrates that even if the current IPO valuation is lower than that original Adobe offer, the market has already shown this definitive willingness to pay significantly more for what Figma brings to the table, its innovation, its user base, its indispensable position in the design ecosystem.
I agree that the Adobe saga seems like a powerful market validation on the surface. And yes, that $1 billion termination fee was certainly a massive windfall for Figma, no doubt about that. However, I'd argue it's actually something of a double-edged sword. And it critically complicates the picture for investors trying to assess Figma's true underlying financial health. The failed acquisition, despite the current IPO price being lower than the Adobe offer, means that the, let's call it, burden of high valuation persists. Investors are still, perhaps implicitly, looking at a company that was once valued dramatically higher. And that historical expectation, even if it's unspoken, can weigh on the stock's performance in the long run. Creates pressure to justify that past perceived value, which might be unrealistic now. Critically, and this is a point you absolutely must understand, that $1 billion termination fee profoundly distorted Figma's 2023 and 2024 financial reports. It makes their actual operating performance unclear if you just glance at the headline numbers. That fee was a one-time, non-recurring event. So to put it plainly, without that colossal one-off payment, 2023 was effectively a loss for Figma. From their core business operations, they would have reported a significant operating loss. So the key insight here for investors is clear. Figma's impressive 2023 profit wasn't really from its core operations. It was a one-time windfall from Adobe. And this radically alters how you should assess their historical financial health and, more importantly, their future profitability trajectory. It raises an important question, right? Are investors fully factoring in this non-recurring income when assessing the company's past performance? Or are they mistakenly viewing that one-off profit as a sign of sustainable operational profitability from their core product? It's a nuance that can, and often does, significantly alter a company's financial narrative for a diligent investor.
That's a very clear way to put it, distinguishing between those one-off gains and sustainable operational performance. It's vital for any investor. But looking ahead now, despite that historical nuance, Figma's balance sheet currently looks remarkably robust. It gives them a very strong financial foundation for future growth and, strategic maneuvers. They hold approximately $1.56 billion in cash equivalents, and marketable securities. And that's against a comparatively modest $330 million in debt. That's a very, very healthy financial position. It provides plenty of dry powder or liquid capital for their ambitions without being burdened by excessive leverage. And their ambitions are clearly tied to future growth drivers, particularly deep AI integration. Figma is strategically focused on this, positioning itself right at the forefront of the AI-powered design revolution. A key feature here already in development, apparently, is Figma Make. Now, this isn't just some small add-on. It represents a potentially massive shift in how design can actually be done. It enables users to generate sophisticated design prototypes just from simple conversational prompts. Think typing in a description and watching a basic app interface appear, and even convert these designs directly into production-ready code. This could significantly streamline the entire design-to-development process, reducing manual labor and accelerating product launches dramatically. The growth potential driven by AI for Figma is truly exciting, potentially explosive even. Industry predictions anticipate an astounding 1 billion new applications will be created by 2028. 1 billion. And a significant portion of those are expected to utilize Figma's collaborative and AI-powered tools at various stages. That's just an enormous, rapidly expanding growth runway for the company. It positions them as an indispensable tool in this burgeoning app economy. They're not just reacting to trends here, they seem to be actively shaping them. Beyond just AI, Figma also demonstrates what seems like a genuinely future-oriented approach in its asset management, which is quite intriguing and signals perhaps a forward-thinking leadership. As of March 31st, 2025, Figma was holding $70 million in Bitwise's Bitcoin ETF, and they apparently have stated plans to invest an additional $30 million. This demonstrates a willingness, I suppose, to embrace emerging technologies and asset classes that maybe defy traditional corporate finance norms. And it's not just about internal growth and organic expansion either. The CEO has explicitly stated their intention to pursue bold acquisitions and actively use IPO funds for strategic mergers and acquisitions, M&A, and broader platform expansion. This signals highly proactive growth strategies and a clear vision for consolidating their market position, expanding their offerings, and maybe even venturing into new adjacent markets.
Well, while that strategic focus on AI is certainly crucial and frankly a necessity for any modern tech company aiming for sustained relevance, it's important to inject a note of caution regarding its potential double-edged nature. Figma itself has, quite prudently I think, warned that AI-based design tools could potentially reduce customer platform dependence. This is a significant, if somewhat paradoxical, risk. If AI makes design too easy, too automated, or allows for more fragmented, task-specific workflows, it could inadvertently make their own comprehensive platform less essential in the long run. Imagine a scenario where a user only needs a quick AI tool for a design snippet rather than the full collaborative suite. It's a really delicate balance for Figma to maintain leadership without, well, cannibalizing its own core product utility. As for the Bitcoin ETF investment, while it's framed as future-oriented and innovative, it also undeniably introduces exposure to a highly volatile asset class. For a company going public seeking stable investor confidence, especially given the market scrutiny of IPOs these days, this kind of exposure, even if it represents a small part of their overall $1.56 billion in cash and equivalents, could be a risk factor. Some institutional investors, traditional analysts, might really scrutinize that. It just adds an element of unpredictability to their balance sheet performance. And this raises another important question for long-term sustainability. How will Figma balance its significant R&D spend evidenced by that near tripling of expenses in 2024, much of it likely AI-related, and its ambitious acquisition plans with achieving sustainable profitability in the long term? Especially if AI innovation reaches some kind of saturation point, or if competition intensifies, either from traditional rivals like Adobe or from new, disruptive AI-native tools. These are not trivial concerns, and they speak to the enduring challenges of sustaining hypergrowth in such a rapidly evolving technological landscape.
Those are absolutely critical questions, and they really highlight the complex tapestry of factors influencing Figma's future. What's truly fascinating now is how these factors are perceived, how they're interpreted, and how they're acted upon, because that varies wildly across different online communities. This brings us to a fascinating divergence and also some surprising conversions of sentiment, especially when we look at the discussions unfolding on, say, Reddit in the US compared to the equally fervent online forums over in Korea. Let's start with the US Reddit community. It often acts as this primary, if sometimes chaotic, arena for US retail investors discussing and strategizing on major IPOs.
Right. On Reddit, you almost invariably find this dominant atmosphere of speculative interest. It's an almost palpable focus tied predominantly to short-term price movements and the potential for quick profits. There's significant chatter about the IPO price itself. Some analysts, particularly those doing discounted cash flow, DCF valuations, that's a common method to estimate a company's true worth based on projected future earnings, actually found the $25–$28 range to be, quote, fairly priced. Consistent with a DCF fair value around $27.50. This actually surprised some users, as IPOs are so often seen as immediately overvalued right upon listing. And when they compare the $16 billion IPO market cap to Adobe's failed $20 billion, or maybe closer to $30 billion acquisition attempt, some Redditors actually saw it as a good deal on the surface, kind of implying a discount from its previously perceived value. However, and here's where it gets really insightful on Reddit, the overwhelming prevailing view, the narrative you see repeated constantly, is that the stock is likely to double its offer price in the first few days post-listing, followed by a significant drop later this year. This is repeatedly called out as a very common pattern for tech IPOs. It's a narrative almost universally accepted within these trading circles, and because of this deeply ingrained expectation, you see strong repeated warnings against FOMO, that fear of missing out buying for long-term holding. The advice for long-term investors is incredibly specific and consistent. Wait for 2 to 3 earnings reports before you even consider an entry point, and definitively avoid bag holding, that is, being stuck with shares whose value has plummeted, because, as they say, initial excitement fades quickly, and that so-called IPO pop often proves unsustainable. Users on Reddit frequently cite specific cautionary tales from past IPOs, like Arrow, which saw a rapid 3x surge only to collapse spectacularly, or Riven, which experienced an initial spike but then lost something like 90–95% of its value shortly thereafter. Even Reddit's own recent mixed IPO experience often gets brought up as a cautionary example. So for day traders, the strategies are explicit. Buy and sell quickly when the stock is high, aiming to scalp those immediate profits, or maybe trade tops and bottoms until it stabilizes later on. On the more pessimistic side, you see direct predictions like, this stock is going to tank right after that initial pop, emphasizing the short-term nature of any potential gains.
Yeah, it's absolutely true that the Reddit community is just steeped in caution, particularly for anyone thinking about long-term holding from day one. But even amidst that pervasive skepticism, that focus on short-term gains, there are actually very strong optimistic undercurrents. Foundational beliefs coming out of Reddit itself regarding Figma's product. Many users passionately describe Figma as the absolute standard for design execution. They emphasize its exclusive position and strong moat in UX. Now, this is critical because it highlights a deep, almost indispensable product loyalty and utility for countless professionals. A huge number of users genuinely consider Figma essential for their daily work. That indicates a powerful underlying demand, a product stickiness, regardless of short-term market fluctuations or speculative trading. It really speaks to the fundamental quality of the business itself. There's also the positive observation that Figma has continued to grow larger and faster, even after the Adobe acquisition attempt fell through. This suggests that its robust underlying strength, its impressive growth trajectory, they aren't reliant on some massive M&A deal for validation or expansion.
The company truly seems to stand on its own merits. There's even speculative talk within these forums about Figma potentially expanding into other Adobe product areas in the future, given its strong platform and widespread adoption. That indicates perceived long-term growth avenues far beyond just its current core offerings. Now, for retail investors actually trying to get in at the initial IPO price, Reddit discussions also address the very practical, often frustrating considerations. Generally difficult. Why? Overwhelmingly high demand and the typically random allocations you get from brokers like Robinhood. While the stock officially becomes a regular stock, tradable by anyone on July 31st, the actual market open time on that day is often random, unpredictable. Furthermore, brokers might have these maximum request price limits for initial orders, potentially requiring you to re-request your buy if the opening price swings too widely. So yeah, while the sentiment on Reddit is definitely cautious about long-term holding after an initial pop, there's also this clear, almost reverent recognition of Figma's powerful fundamentals and its commanding market position. Now let's switch gears dramatically and look at the Korean online forums because they offer a distinctly different yet equally high-interest perspective on the Figma IPO. It's fascinating. In the Korean community, Figma is spoken of with incredibly high praise, sometimes bordering on reverence. It's often referred to as the Google Sheets of design, which really highlights its collaborative indispensability, or even the Tesla of design, which truly captures the significant anticipation and transformative potential they see in the company's innovation and market disruption. These aren't just casual comparisons. They seem to reflect a deep belief in Figma's long-term impact and category leadership. This high expectation in Korea seems partly fueled by recent successful tech IPOs like CoreWeave and Circle, which have performed exceptionally well over there, creating this generally bullish sentiment for new tech listings. While valuation concerns do exist, yes, it is seen as overvalued on revenue price and profit price. By traditional metrics, this is largely accepted as normal in the current AI-centric tech market.
It seems like a collective recognition that for companies at the forefront of AI, future potential and market leadership often outweigh those traditional backward-looking valuation metrics. The primary growth drivers identified by the Korean community focus heavily, almost unequivocally, on Figma's leadership in collaborative design and UI/UX, especially its tremendous potential with AI tool integration, specifically mentioning Figma Make to generate prototypes and code. This AI-driven narrative is incredibly strong there. It's seen as the next big frontier of growth. They frequently reiterate that 2028 forecast of 1 billion new apps, with many expected to use Figma, firmly underlining that AI-driven growth narrative as the core investment thesis. They also strongly reinforce the strength of Figma's recent quarterly revenue growth, those clear signs of profitability emerging from Q1 2025, and a very healthy balance sheet, all of which are viewed as powerful indicators of operational health and future potential, the 95% Fortune 500 adoption rate we mentioned, also seen as a definitive sign of strong enterprise adoption and profound market trust, cementing Figma's position as a truly mission-critical tool.
Furthermore, the CEO's stated intention to use IPO funds for bold acquisitions and platform expansion is viewed very favorably. It signals proactive, aggressive growth strategies that they believe will further consolidate Figma's dominance. Favorable external factors, like the broader software as a service, SaaS market recovery, and the ongoing global expansion of collaboration-centric work environments are also frequently cited as positive tailwinds for Figma's continued success. Even Figma holding $70 million in Bitwise's Bitcoin ETF gets interpreted here as a future-oriented approach to asset management, showcasing a progressive and forward-thinking leadership team. Now, from a day trading perspective, specifically within the Korean community, there's a strong consensus. They expect strong demand and a significant price surge on IPO day. They're anticipating a very active and volatile market. They note that the founder and VCs selling some shares is seen as a logical liquidity event for early investors, but importantly, the founder retained overwhelming control. That's viewed as a good sign of leadership stability and commitment to the company's long-term vision.
There's even rampant speculation apparently on the possibility of Figma becoming this year's largest IPO if demand truly surpasses the top of the offer range. That signals extreme bullishness for the immediate market reaction.
Okay, while the Korean community's optimism is certainly palpable and it's well articulated based on those points, it's essential for you listening to remember that the burden of high valuation persists, even with an IPO price that is lower than the failed Adobe deal. That historical benchmark, whether consciously or unconsciously, just sets a very high bar for performance. And just like we discussed earlier, if Figma's growth slows down, even slightly from its current rapid pace, it could quickly lead to significant stock price pressure. The market just has incredibly high expectations for these growth-oriented tech companies. Any perceived deceleration can be met with swift investor disappointment and a reevaluation of those lofty valuation multiples. And we cannot, under any circumstances, ignore the strong competition in the broader design tool market. You've got established behemoths like Adobe with its entire Creative Cloud suite, specialized players like Sketch, and these rapidly growing, more accessible platforms like Canva. Maintaining continuous technological superiority isn't just a strategic goal for Figma, it's an absolute necessity if they want to retain their market leadership and justify their premium valuation. It's a constant battle. Furthermore, Figma's global revenue structure, while a strength in many ways, also makes it vulnerable to external macroeconomic factors. Think about potential tariffs in international trade disputes or just a general decrease in global customer spending. That could lead to demand slowdowns in various regions. And a critical warning coming from the Korean community, surprisingly echoing the sentiments we heard on Reddit, is that due to the expected strong demand, most retail investors entering on IPO day might find the stock even more overvalued than its initial offering price by the time they can actually execute a trade. The high market volatility characteristic of tech IPOs is also well understood there. It signifies that rapid price swings are just expected, part of the game. So this raises an important question that you must consider. While both communities expect a day one surge, does the Korean community's longer-term AI-driven narrative provide a kind of false comfort about potential support for the stock after the initial speculative frenzy? Especially when you compare it to Reddit's more direct pump and dump concerns, it seems the underlying rationale for why they expect the surge differs significantly, and that difference could profoundly impact the post-IPO behavior and the stock's trajectory in the weeks and months following its debut. It's a crucial distinction.
You've hit on a really fascinating and crucial point there, and it leads us directly into unpacking this divergence and convergence of market sentiments, especially as they relate to actionable day trading strategies. Here's what truly grabs my attention when we look at this next point and what I think will really resonate with you listening.
Despite their often starkly differing long-term outlooks, both the U.S. Reddit community and the Korean online forums share this powerful, almost unanimous consensus. Figma stock is highly likely to open at a price significantly higher than its offer price and experience a substantial initial surge. This is a rare point of agreement across such disparate and frankly opinionated communities. That makes it an exceptionally strong indicator for day one trading dynamics. This shared expectation, combined with Figma's objectively strong product, its dominant market position, its immense AI potential, and just the generally hot IPO market atmosphere we've been seeing for successful tech debuts, well, it's likely to create a powerful self-fulfilling prophecy. When a critical mass of day traders expect a surge and act aggressively right at market open, placing large buy orders, immediately they can collectively and rapidly drive that price up. This means opportunities for quick gains will likely appear and unfold very quickly, often in a matter of minutes, maybe even seconds. And critically for you, if you miss that early part of the trading day, you could easily find yourself entering at already overinflated prices, potentially well above the initial opening pop. So for day traders, impeccable timing, lightning-fast execution, and precise order management are going to be absolutely paramount if you hope to capitalize on this anticipated initial volatility.
Acknowledging that broad consensus on the initial surge is vital for understanding day one dynamics, absolutely. But you're exactly right to emphasize that opinions diverge significantly on the sustainability and the duration of this surge. Reddit, as we discussed, strongly suggests a quick peak and subsequent decline. They view it as a high-risk, high-reward, fast trade. You get in, you get out. The emphasis there is purely on that fleeting, short-term, speculative opportunity with very little belief in its holding power immediately after the IPO. Now, contrast that sharply with the Korean community's expectation of a surge. Theirs is rooted in a deeper belief in the company's long-term potential, particularly that AI narrative we talked about. This deeper conviction could potentially provide more support for the stock and maybe a slightly slower decline, or perhaps even sustained interest, even after the initial retail frenzy subsides. However, it's crucial to acknowledge that this long-term support is still a highly speculative area, especially in the immediate post-IPO environment. Things can change fast. The critical insight for you to grasp here, I think, is that the initial surge might be driven more by speculative retail money flow, people just chasing momentum, than by a genuine fundamental revaluation of the company based on deep financial analysis. Understanding this distinction is absolutely crucial for determining your entry and exit points, as the very nature of the buying can dictate how quickly that momentum dissipates. Is it real conviction or just short-term chasing? Okay, so based on these rich community insights, we can outline a few tailored day trading strategies. Each has its own distinct risk profile and potential rewards. First, there's what you might call momentum scalping. This strategy involves buying immediately after the market opens or just after the initial surge begins and selling into the first significant wave of buying. Think of it like catching a quick wave. A trader would aim to buy within the first few seconds or minutes of trading, riding that rapid upward momentum, and then exiting when the buying pressure shows the first signs of slowing, often within minutes. This strategy requires rapid execution and strict risk management because you're in and out very quickly. You're capitalizing on short-lived momentum, and even a minor hesitation can lead to significant losses. Then for, let's say, more aggressive traders who are comfortable with higher risk, you might consider the fade the pop strategy. This involves looking to short sell, that is, betting on the stock price to go down when that initial surge shows signs of exhaustion. The premise here is to anticipate that big drop that's widely predicted on Reddit after the initial excitement fizzles out. A trader might look for specific technical indicators, maybe a sharp parabolic move followed by a reversal candle, or a sudden drop in buying volume as signals to enter a short position. However, be warned, this strategy carries extremely high risk for IPO stocks. Those initial parabolic moves can quickly, violently liquidate short positions if they're not managed with extreme precision, really tight stop losses, and a deep understanding of market mechanics. It's definitely not for the faint of heart. Finally, there's a more conservative strategy. It's widely discussed across both communities, particularly for less experienced retail investors. That's avoiding IPO day altogether. Given the strong warnings that the stock might be overvalued by the time retail investors can actually get in at an accessible price, and the inherent difficulty of securing shares at the original IPO price anyway, a prudent approach for many is simply to wait. This means waiting for price discovery to happen, allowing the market to naturally settle on a more stable valuation after the initial frenzy dies down, and also for potential volatility after those lockup periods expire. Lockup periods, remember, are legal agreements preventing early investors and insiders from selling their shares for a set period, usually 90 to 180 days post-IPO. When these expire, it often leads to a significant increase in share supply, which can cause downward pressure on the stock price. Waiting allows for a clearer picture of the company's fundamental performance and potentially a much more favorable entry point.
Right. And building on that, if your goal is truly long-term investment, if you see Figma as a company you want to hold for years, not just hours or days, then the communities offer really clear, consistent advice. Patience is absolutely key. The long-term entry patience strategy advocates for exactly what you heard, waiting for 2-3 earnings reports or until the stock stabilizes after the initial volatility has passed. This is generally deemed prudent because it allows the company's actual operating performance, its revenue growth, its profitability margins, its forward guidance to be revealed through audited financial statements. These reports provide far more reliable data than just day one speculative trading chaos. And stabilizes basically means waiting for the stock to settle into a clearer trend where those extreme daily price swings become less common and its valuation begins to align more closely with its fundamentals rather than just pure market sentiment or hype. This really highlights the different approaches you as a listener might take, depending on your individual risk tolerance, your investment horizon, and your overarching financial goals. It's definitely not a one-size-fits-all situation, is it? Understanding these differing strategies is essential for making truly informed decisions on IPO day and, well, far beyond.
Absolutely. And beyond these specific strategies, there are several critical factors you absolutely must consider when making any IPO day trading decisions, as they can rapidly shift the landscape on you. Firstly, the opening price versus the offer price. The magnitude of that initial surge, that difference between where the stock is offered and where it actually opens for trading, will directly determine your potential profit margins and, crucially, your immediate risk. A stock opening significantly higher, for example, means less immediate upside for day traders entering late and a higher risk if that initial pop proves fleeting. Secondly, trading volume and liquidity are paramount. High trading volume is generally your friend as a trader. It allows for quick entry and exit without significantly impacting the price with your own trades. Without sufficient liquidity, trying to enter or exit quickly can become a significant challenge. There might just not be enough buyers or sellers at your desired price when you need them. Thirdly, you must observe the broader market sentiment for tech IPOs. Recent successes, like those of CoreWeave and Circle we mentioned, suggest a currently favorable market environment for new tech listings, creating a sort of bullish backdrop. However, this sentiment can change rapidly, really rapidly. A single negative piece of news, a significant interest rate hike announcement, or even just a poor showing from another high-profile IPO could shift the entire market mood overnight, dampening enthusiasm for all new listings. You have to watch the context. Fourth, pay close attention to news flow on IPO day itself. Any unexpected news, positive or negative, or even revised analyst ratings released right on IPO day can significantly impact the price in real time, sometimes causing dramatic swings. You need to be prepared to react quickly and have a plan for unexpected developments. And finally, and perhaps most importantly for your own financial well-being, understand your individual risk tolerance. Let's be blunt. IPO day trading is inherently highly speculative and not suitable for all investors. The potential for rapid gains is matched by an equally rapid potential for significant losses. You must only trade with capital you can genuinely afford to lose. And crucially, have a clear, predefined exit strategy in mind for both profits and losses before you even think about placing a single order. Risk management is absolutely key here.
So what does this all mean for the bigger picture then, beyond just Figma's immediate future? Well, the Figma IPO feels like far more than just an assessment of a single company's fundamental value. It's really a critical test, isn't it, of the overall sentiment and liquidity within the current tech IPO market, especially concerning the collective psychology and the risk appetite of retail investors. Think of it almost as a bellwether for the broader market. A strong debut for Figma, particularly if it manages to sustain its initial gains for a reasonable period, could further fuel the enthusiasm for future companies wanting to go public. It could potentially open the floodgates for more tech listings later this year, signaling a broader market willingness to embrace new, growth-oriented tech. Conversely, a significant drop after the initial pop, a rapid fizzle of excitement. Well, that could serve as a cooling-off period for what many perceive as an already overheated market. It might make future IPOs face tougher scrutiny. Therefore, for day traders, observing the broader market's reaction to recent IPOs provides really crucial context for understanding Figma's potential trajectory. It's not just about Figma in isolation. It's about the broader market's appetite for innovation, for growth,
and maybe most importantly for Rick right now.
Precisely. And if we connect this to that bigger picture, this isn't merely an investment in a company. It could very well be an investment in a broader market trend. Understanding this dynamic that collective sentiment and action can heavily influence initial performance, sometimes even overriding traditional fundamentals on day one, is absolutely key. Not just for navigating Figma's debut, but for future IPOs you might encounter in this volatile market environment, which again raises that important question for you to consider. In a market driven so heavily by sentiment and collective action on its very first day of trading, how much can fundamental analysis truly protect you, the individual investor, on IPO day? The answer, for many traders, is probably very little. And that just underscores the speculative nature of these initial trading periods, making risk management absolutely paramount.
And that's our deep dive into the fascinating, definitely high-stakes world of the Figma IPO. We've explored its innovative and, for many, indispensable platform, its intriguing and sometimes complex financial journey, the starkly different, yet sometimes converging sentiments of global online communities, and the high-stakes strategies of day traders looking to capitalize on those immediate market movements. From that powerful consensus on an initial price surge to the really contrasting views on long-term sustainability, it's clear that Figma's debut would be a significant event. It's going to test both a company's inherent resilience and the market's evolving appetite for risk and growth.
Ultimately, what stands out here, I think, is that persistent tension. The tension between a company like Figma, which seems fundamentally built for decades of compound growth and long-term value creation, and a market that is often focused on immediate speculative gains and short-term price movements. The core message from Figma's CEO, Dylan Field, explicitly not promising short-term stock growth, but emphasizing long-term value and sustained innovation, that's a powerful message. It's one that every investor, especially those eyeing day one trades, must genuinely internalize and weigh against the market's often frantic initial impulses. And here's maybe a provocative thought for you to mull over as we wrap up. If the collective anticipation of an IPO surge can indeed become a self-fulfilling prophecy, what does that imply about the true discovery of a company's fundamental value on its very first day of trading? Is it truly a fair reflection, or is it merely a transient snapshot of collective excitement and momentum?
That's a truly insightful point to consider as you reflect on this deep dive. Now, before we go, a very, very important note for everyone listening. The information provided in this deep dive is strictly for informational purposes only. It should not be construed as investment advice. Any investment decision, including those related to initial public offerings like Figma's, carries inherent risks, including the potential loss of your capital. It is absolutely crucial that you conduct your own thorough research, perform your own due diligence, and consult with a qualified financial professional before making any investment decisions.
Additionally, please be aware that the content discussed in this deep dive is based on the provided source material and reflects information that may have been generated or processed by AI. While we always strive for accuracy in conveying the source material's insights and interpretations, information generated by AI can sometimes vary. It may not always capture every single nuance or reflect real-time market changes perfectly. You bear the sole responsibility for any investment judgments and decisions you make, and for understanding the implications of any information differences that might arise from AI-generated content. Your personal research and professional advice should always, always be your primary guide.
Thank you so much for joining us on the deep dive. We really hope this exploration has given you the knowledge and maybe some of those aha moments you're looking for, helping you navigate the complex world of market events with a bit more confidence. Until next time, keep digging deeper.